Testing. Testing. All right, so we only have 2 weeks together. So my plan today is to go finish up options, and if we have some time, talk a little bit about cryptocurrencies, but specifically Bitcoin, and hopefully we end the class either finishing up a video. I think it's a good introduction to what cryptocurrency is about, or we watch halfway and then you finish the rest of the video uh, at your own pace. And then the next week is completely focused on just preparing for the final exam. So I'll give you some in-class final exam questions. Of course, I'll tell you the kind of questions to expect, and we'll just do it together. We'll just spend the entire class doing practice problems. So that's my plan. All right, so where we left off for options, we were talking about how to use options to hedge against, explaining the subtleties of hedging using options depending on whether or not you have an asset or a liability position. And so where we left off was hedging against large increases in value or drops in value. We can do the same for small drops in value. So here, the difference is that we are going to give up the upside. All right, so that means that our upside is going to be capped. But again, it depends on the situation that you're in and whether or not you want to, bet against a small drop or a small increase, I believe, right? Small drop and small increase. All right, so let's go ahead and try to talk about hedging against small drops in value. So if we go up to our table again, if we're hedging against small drops in value, we're talking about an asset position, and we want to hedge against, obviously when we have an asset position, we want to hedge against it going the opposite direction. And so we're talking about small drops in value. In this case, we want to give up the upside, but when we do this, of course, we will have to do something that allows us to go in the opposite direction of our original bet. And so rather than buying a put, which is allowing us to go betting against the other direction, we of course can also sell a call, which was give us something like a put, right? So let's talk about this scenario in which we have an asset position and we're going to sell a call option. So let me write here asset position, and then we're going to engage in a sell call or short call position. So again, just like last week, I'm going to give you two ways to visualize or to think about analyzing our hedge. One is through a payoff table, and the other is through graphical visual representation. So our table is going to look like the following again. You just highlight everything, make sure it's the same size. Medium, how about medium? And so we look at the payoff at time t equals 0, maybe larger. And ET less than K, and K is less than ET. So here we're looking at the payoff at maturity and thinking about the two types of states of the world, right? Either the underlying asset is below the strike price or above the strike price, and we're thinking about what the payoff is going to look like, given the combination of two positions. One is an asset position in which we expect to make money from a sale of an asset in conjunction with a sale of a call option. So when we sell something, we get something up front, but we may have to pay out if the underlying asset exceeds the strike price, right? We have to pay the buyer of the call option that we sold at time 0. And that's not good for us because we're the one issuing the call option at time 0. So if we are an asset position, we bought the asset, presumably at the beginning, so it's a minus t, and then we'll get a payoff of E capital T regardless of the state of the world. But if I have a call option, I will have received something for selling the call option, but I will have to pay out only in the state in which the buyer of the call option purchases, I mean, the buyer of the option exercises the call option, which is the good state, right? So the good state is, sorry, it's a minus ET minus K, right? ET minus K is the scenario in which ET is greater than K, but it's a minus sign because I have to pay out the person who bought the, I have to satisfy the agreement, right? If the buyer exercises the option. So let's see. So maybe I'll just shrink this. Nope. Okay, let's keep it large and maybe adjust things a little bit. Okay, so let's add everything together. So our overall portfolio looks like the following: C minus underscore T, ET for the scenario in which the underlying asset falls below the strike price, and K, positive K. So let me write a plus sign, meaning we're adding the two rows together, and our final portfolio payoff at time 0, C minus E over underscore T. And based on the future payoff, right, they're both positive values. So as we can expect, this number, if it's no arbitrage condition, must be negative, right? You can't make something from nothing. All right, so we can visually represent these payoff in the following manner. So we have an unhedged position plus our hedging portfolio, and then that will equal our final hedged portfolio. And just like last week, I'm going to assume that the strike price is equal to, it's at the money. The strike price is at the money. This is just for visualizing the shift in the curve as a result of the sale of the call option. So our unhedged position, we all know what that looks like. It's a upward sloping curve. Our payoff is linear, right? And so let me write E underscore capital T to indicate that it's the future price. Okay. And let me write K equals E underscore T to indicate that this origin is intersects at not a 0, right? At K. So let me copy paste. All right. So our hedged position is a call option. So it's a 0 in all scenarios in which it's less than the strike. So that's this here, right? But we have to pay out something in the future. And so it looks like a negative sloping, right? With this intersection point downward. So if we add these two positions, so we know that a positive slope with some negative slopes going to give us something that's a 0 slope. And the left-hand side here, it's upward sloping. So we should get something that's upward sloping and then with a kink that's flat, right? So if we don't factor in the price of the call option that we sell, then our final payoff looks like this. Sorry, not that. Should be up. Should be up here. This point is K equals ET. Capital T. Or sorry, lowercase t. And then if we were to factor in this benefit, which is negative, right? Our curve will shift downward to this point here. So this point should be C. Okay. So remember, I'm assuming this. So substitute K whenever you see an ET or vice versa, and you should be able to figure out these intersection points. But anyways, what you should notice is that as I as the title suggests, right? You're hedging against small drops in value. That's hedges right here. See this little area here? If there's a small drop in value in the underlying asset, you still make money, right? Your overall payoff is still positive. But large drops, you're getting hurt for sure, right? So you have to know exactly where this this point that intersects the horizontal line in which you no longer are profitable anymore. We are giving up the upside given this bet. So here we see that our payoff is capped, right? So why would you do this? Well, if you're confident that this scenario would never occur, and you're able to sell something for a lot of money up front, then you can see that this position, uh, again, as risk managers, this accomplishes what your expectations are. So if you expect that the underlying asset you don't expect it to budge much. If it does, it's going to fall very, trivial amount. Then you could still make money. On the other hand, if you're totally wrong, right, then your downside is just as bad as before, right? Probably, yeah. Right. So you get some protection, some insurance, right, from the fact that you get this call option, selling this call option, but it's still bad in the very and when the underlying asset falls decreases by a lot. Okay, so takeaway here is the call option is like an insurance, right? You get some protection because you get some offsetting benefit here, right? But ultimately, if you're totally wrong, it could be still really bad, right? All right. So let's do the same, but here we're talking about small increases. So small increases, that would suggest that we are a liability position. And we're probably going to do a sell put, right? So double check. We are now hedging against small increases in value. So that means when the underlying asset increases, that's going to hurt us. So that suggests that we are most likely taking the opposite bet when we are in our original portfolio. So if we have a liability, meaning that we sold something today, have to buy it back cheaper, we hope to buy it cheaper in the future. But if we were wrong, right, we're supposed to take the opposite bet somehow. We can accomplish that with a selling a put. Okay, but here you're giving up all upside just like before, and but you can still make money in a scenario in which there are small increases in value, as you will see. So let's do a payoff table. Sure. All right. So let's look at our original portfolio position. It's a liability, which means we must have sold something today and we had to buy it back cheaper. So you're betting that the underlying asset have decreased in value in the future. So we will receive E underscore T and we will have to buy it back, right, at E underscore capital T. If we were hedging against an increase in value, right? We will hope to ET actually declines, but maybe we're wrong. We could sell a put, as I suggested earlier. And put option is only exercised if the payoff function gives us a positive number in the case where the underlying asset has dropped below the K, right? The strike price. So here our payoff would be minus K minus E underscore T, right? Or in other words, underscore capital T minus K and 0 otherwise. Our payoff, therefore, it's going to look like this. Overall portfolio is minus K and minus ET, right? Because ET minus ET plus zeros that, and the ET cancels out. So minus ET, positive ET, so all you're left with is minus K. And if we were to add everything together, realize that this is negative number, this is a negative number, negative, negative, this can't be negative because you're paying to lose money, which doesn't make any sense. So this should be positive here, right? So we know that you get some protection by selling this contract, but ultimately, you're gonna. There are states of the world in which you lose money, right? That's only fair. So again, let's break it down into three parts: the unhedged position, the hedging portfolio, and then the final hedged portfolio. And I'm gonna write this assumption. Assume that K equals ET in the graphs, which means that the origin is indicating that it's the following. Sorry, it's ET, right? Um, and let me label the x-axis. All right, so liability, that's a downward sloping curve because we are shorting in the, right? So if the underlying asset becomes lower in value, I can buy it back cheaper and make a profit. Otherwise, I'm losing money because I'm buying expensive in the future. Our hedge is going to be a short put. So that means that I get to keep my sale in the case in which the underlying asset exceeds K. So there's a flat line here. But I have to pay out something in the case where ET is less than K. So that's an upward sloping. So this is upward sloping, but it's in the lower left quadrant, which means it's negative, right? So everything below this line is negative. So combining these two graphs, positive slope, negative slope, is a flat line, and then we have downward slope, which means that it's going to look like the following. We don't factor in the profit from the sale of the put. This is minus K. This point here should be minus K. But if we account for the positive sale, then we will get a line that's above the origin here. Like that, right? So it's a upward shift. And this point here should be P, okay? So our description was hedging against small increases in value, and you can see this wedge here, right? This wedge is positive profit in the case in which the underlying asset increases by a little bit, right? So the sale of your put option gives you some insurance or some protection against that, but ultimately, if you're totally wrong in the direction, like the underlying asset increases dramatically, then of course you're gonna lose money. And here we see that the cap, right? Your profits is capped on the left-hand side, given it's a flat line. All right, so anyways, so whether you long call, long put, short call, short put, they give you different types of protection. This is the basic takeaway. So here's a summary. If you buy a call, the call itself, gives you unlimited upside, no downside. To sell it, to buy a put, you get upside in the other direction, and you get downside protection on the other side. But the cost of these positions is that you have to pay a premium up front. So you realize that if you buy a call, if you buy a call, buy a put, you have to pay something up front. selling puts and selling calls, you get the premium up front, so that's the pro, obviously, right? If you're a call, you get the C. If you sell a put, you get the P. But the con here is that you still get significant downside risk, and you give up all upside, as you saw here, right? So here we are selling a put, we are capping our upside, and we get some protection, right? Just a little bit of protection if you're wrong, right, about the hedge. All right, so we know buy assets and sell assets, right? Sell assets is unlimited upside, and then you lose everything you put in. You can possibly lose all value in your asset. Same with short. So if you're totally wrong, you can just have you know big losses. All right, so this is just a little introduction and what I kind of expect to test you on in the final exam. So I will probably ask you to construct portfolio of options, and your job is to construct a payoff table and potentially visualize it with a graph. All right, so these are very simple concepts, right? I just only had one option for one position, but imagine I give you several types of options to, you know, mimic, to precisely pinpoint what kind of exposure I want to take, risk I want to be exposed to. So, for example, if I want to be exposed to FX risk between these two strike prices, you should be able to construct a portfolio that gives me that precise result. Right? That's the whole point of risk management. You tell me what options or put options to buy or sell to achieve a certain exposure. And that's all I'm going to test you on. I'm not going to test you on asset pricing theory. I'm not going to test you on whether or not you know how to use the Black-Scholes, which is empirically wrong to begin with. I'm not going to ask you to do any of that stuff. All right. Again, this is just a practical application course. So if you understand how to buy and sell options and how to visualize your payoff, your portfolio payoff, one period afterwards, that's good enough. Okay. So yeah. So if you understand the exercise that we've gone through here, you should be just fine. All right. So I'm going to review, hopefully, the so-called Greeks of option pricing. So the Greeks refers to Greek letters that's supposed to refer to sensitivity of the option price with respect to different parameters in the call option or put option pricing formula. The reason I'm going through this is because we now have to think about foreign interest rates, right, as a new sensitivity to think about. But again, if you understand option pricing with dividends, then it should be pretty clear how the sign of the sensitivity of the call or put option should be. Anyways, let's go over it together. So option value sensitivity, what we're really talking about is the derivative of C with respect to various parameters. So I'm going to write a bracket here, okay? Or derivative of P for put option price with respect to different parameters. So as I said, different parameters will give me sensitivities with respect to different parameters will be referred to using Greek letters or pseudo Greek letters. So the most popular Greek letter that you must have talked about in your class is delta. So this is what this is referring to, a change in the call or put option price when I change the underlying asset price by a certain amount. So my question for you is, I'm going to ask you, of course, maybe just intuitively, just think about all of this intuitively. What happens to the value of call or put options when I decide to increase certain of the parameters by infinitesimal amount? So let's think about what happens to call price when I change the underlying asset price E. So remember, I'll put this up on top here just to refresh your memory. So call option, call payoff is equal to max 0 E minus, okay, I'm going to skip the the subscript. Put payoff is equal to max 0 K minus E. All right. I'm going to assume European options, so none of that early exercise. So my question, this is review, right? So my question for you is, what direction should the call option price change? Is it positive or negative if I increase the underlying asset price by, if I increase it by an infinitesimal amount? Should it be positive or negative for call option? If you know the answer, just say it. So looking at this, if I decide to increase this value, the gap increases all else equal. Therefore, the call payoff increases, and all else equal, the price, if I discount this payoff back to times 0, it should be positive, right? So this is a positive number, right? So I'm going to write a positive sign here, okay? So I'm going to skip all that calculus terminology and just write positive or negative, and then just, right? So for put option, again, look at the payoff function. I'm looking at an increase in asset price, so E is increasing all else equal. The gap between K and E is shrinking, so the put payoff is therefore shrinking. And so if I were to discount it back to times 0, that means that the payoff is also shrinking. So I should have a negative sign here. Concur? All right, again, this should be all just review. Exercise price. I don't believe there's a Greek letter for this, but anyways, we can look at the sensitivity of the payoff functions with respect to change in K, right? So let's just write K. So for exercise price, we can look at this here. If the strike price is higher, is my call payoff lower or higher? It looks like it's going to be lower, right? Because the gap between E and K is smaller, payoff function is smaller. Therefore, my price I'm going to pay for this also smaller. So it's minus sign. Put options the reverse, right? Because this is increasing positive. All right, volatility. So these two so far, very intuitive, right? Because you just look at the payoff function, you should know the sensitivities. Increasing value decreases the max payoff function at maturity. So if I just think about it, discounting it back to times 0, that's how you price things, right? And the CAPM world, that should give me a lower price or a higher price, right? Depending on whether or not the final payoff is higher or lower. For volatility, it's hard to see unless you know, if you've seen like the binomial tree model or something like that. So I'll walk you through it a little bit of it just to make sure everybody understands why it has that direction, okay? Yeah, so for volatility specifically, we're looking at the variance. So let me write the square root of the variance of E, right? That's volatility. So the intuition is the following. If it's very volatile, if the underlying asset is super volatile, then there's more of a chance that the underlying asset E could exceed or fall below the strike price. So the greater the volatility, the more valuable your options are. So that means that it's going to be positive for both call and put. All right. The Greek, so-called Greek letter here is Vega, but it's not a Greek letter. Just what they call it. It's a V. Okay. I'll write out Vega here in case you don't know. Interest rates. This sensitivity is called rho. It looks like a P. Okay. Let's just write. I'll draw it. So it looks like this. It's called rho. So the intuition, right? Intuition is the following. Think of options also fairly similar, comparable to a futures or forwards contract, right? There's a maturity date, but there's an option now to make an exchange at the maturity date. But the idea of the cost to carry still, the intuition still carries through, right? So if the cost of carrying the underlying asset all the way to the the possibility of now selling in the future, you will transfer that cost of carrying to your to the person who honors the contract here, right? So here, if interest rates increases, then my cost of carrying is going to increase, which means the option price should therefore also increase as well, right? Again, future price, option price, quite similar, right? It's like it's for a exercise at maturity, right? It's the same. The only difference now is they have the option, but not the obligation, right, to exercise at maturity. But the idea of the cost of carry still makes sense here. So if the cost of carry increases, then that's going to be reflected by the price, which means that this is going to be positive, right? And then it's the opposite for the other direction. Right? Because it's just the reverse. If you're going to pay for a call option, you want it to be delivered, and therefore you have to pay a higher price if the delivery costs more. The other side, you're going to deliver if it's going to be if the cost of carry is going to for put option is the other way. You're selling, right? So if it's cheaper to deliver, then uh, the put price is going to be lower now, right? So more expensive to deliver is going to be lower put price. Time to until expiration. So this is just maturity date. This is theta. Okay, so maybe I write something here just to make sure. Use forward future price cost of carry explanation, right? If cost of carry increases, C increases, and then you can think through put price as well. Same idea. All right, time until expiration, theta is called theta. So there's a sensitivity of the call price or put price with respect to T now. So this idea is very much related to this K idea. So K is, sorry, not K, this volatility idea. So volatility, if it's very volatile, then over a fixed time horizon, there's a higher chance that the underlying asset would fall below or above the strike price, right? So benefiting the put option or call option, right? Regardless. Theta is the same idea. If the volatility is the same, but the time until expiration has been lengthened, then you have effectively increased the likelihood that the underlying asset price could fall below or above the strike price. So again, you should have positive for both cases, right? So let me write here, more volatile equals higher chance of falling below above. Okay. Here, sorry, this one. Let me draw a line here. More time, higher chance of falling below above. Okay. And finally, we have foreign interest rates. So I think the best way to see this foreign interest rates to think about the UIP relationship here. So if foreign interest rates rise, all else equal, if everything else stays constant, we should expect our underlying asset to move in such a way that R and R star gap closes, right? So we should expect an increase in E, right? In which our is that right? Yes, right. In which our underlying asset is now going to be sorry, let me see. So I'll write it this way. Okay. So if it's like this, then something on the right hand side has to move. This term has to be lower, right? Somehow, if R star is higher, right? This means that our future asset value must decline, right? So if you think about it that way, then this means that E is going to be worth less in the future, right? And so that's gonna actually hurt the value of the call option, in which case we should get a minus sign here. So that's one way to think about it, right? So let me say that again. Higher foreign interest rates means that there has to be expected depreciation. The return on our foreign currency has to decrease, right? So that's what E minus E over E. So don't think about domestic currency now. It's just foreign currency returns. So foreign currency holding onto the asset must have lower returns, which means the underlying asset is going to decrease in value, and therefore that's going to hurt our call option because we're betting that the underlying asset increases in value. So that's why we get a minus sign. And here is a positive sign. The reverse for put. If you don't like it, think about it that way. You can also think about it in terms of dividends. So if more dividend payments earlier before maturity, then we expect the price of the stock to reflect that payments of dividends before maturity, because ultimately you're not delivering the dividend payments, right? You're not delivering the dividend payments. You're only giving away the asset. So the price is going to be lower if there's more dividends coming out of this asset before expiration. Same thing for put. I mean, this is the reverse for put options. So, all right, so two ways to think about this, right? One is UIP, right? UIP says there must be equivalent foreign currency depreciation if R star increases. So that means underlying asset decreases in value, which means that call option is worth less, right? So I'm just talking about call options now. That's one way to think about it. The other way is to think about foreign interest rates like dividends. So for a stock, if it emits more dividends before maturity, then the price is going to be doesn't have to be as high, right? When you deliver the asset, because again, you're not delivering the dividend payments from now until exercise. You only deliver the asset itself without the dividends, right? That occurred beforehand. So lower price, therefore, right, for the call option, and then the reverse for put option. So I'll let you think about the opposite, but it's the same logic here. All right, so that's the difference. Okay, that's the only difference, which is this. I don't think there's a Greek letter for this, but anyways, that's what I have. Let me see if I have currency options. All right, I talked about this already. So the next stuff is valuation. So let me give you an overview of how to think about valuation, because this is important in my discussion of a new topic, applications of options from the policy perspective. All right, so if you're thinking about doing interest rate strategies or any sort of strategy or policy work, you have to think about how to use the option markets to forecast people's beliefs about possible realization of the underlying asset. Okay. Let's see. All right, so my overview. So I won't talk about Black-Scholes. I will just give you the formula and how that's different because of because of foreign currency returns. I just want to just give you a intuitive hand wavy explanation of why it's different, why it's fundamentally different than CAPM, capital asset pricing model. So I presume that you had at least two classes where you had to use CAPM to calculate WACC and whatever, right? To do your investment valuations, blah blah blah. But why is it fundamentally different than CAPM? Well, Black-Scholes is different because it involves pricing things based on states of the world. Okay, so that's different from CAPM because in CAPM, risk is scaled linearly, right? So again, we can see that right in our plots in which our asset portfolio, right, it increases upward this way, downward this way, upward this way, downward this way. There's no kinks, there's no discontinuity, there's no contingent payoff based on the realization of the world. And so this is where option pricing really is really fundamentally different, right? We have to generalize asset pricing beyond this risk return concept in CAPM. Okay, so it's a feature, this state, right? So remember, we're talking about state contingent, depending on the realization of the future. That's how we should price things as opposed to just, portfolio minimization, maximization, right? Risk return, blah, blah. That's too simple, right? The world is much more complicated than that. So we want to capture this feature of the state dependency, in which payoffs depends on what happens in the future. So if you do decide to use DCF to price options, remember, CAPM is a generalized asset pricing model for all assets. That means you can price futures, options, stocks, bonds, blah, 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 anything, literally anything with CAPM. But that's wrong because DCF does not, as I said, doesn't rely on state dependency, doesn't depend on the states to price things. And if you do decide to use CAPM to price options, what you're really doing is you're taking an average of the discount rates and using that discount rate to discount those cash flows coming from CAPM. That's not accurate, right? Because as I explained last week, ideally you want a state different discount rate for every state of the world, right? Good, bad, or that's very simple, right? Good or bad, up and down. But of course, states of the world can have infinite possibilities, right? But anyways, that's what option pricing is heading toward. It's a generalized asset pricing model that can price any kind of contract that you write, like literally any type of contract that you want. And if you have assets that can pay off in every different state of the world, then you can price literally anything, right? That's kind of, I hope, what you learned last semester, maybe, right? If you have a so-called complete market, right? Every asset pays off something in some states of the world, you can price any asset. And that's where option price, deviates away from CAPM. It's looking for these state conditional discount rates. So yes, this is what the last bullet point here is. We're looking for up and down states to apply different discount rates, and this is what's called the risk neutral probability. So I'll talk about that after I talk about the binomial tree model very quickly, okay? Okay, my job is not give you the full, I'm not gonna ask you to prove it, all right? This is just highlighting why it's different than CAPM. All right, very simple model. Let's look at a binomial tree model. It's not realistic, obviously, because stocks don't move, in just two states of the world. They have a spectrum of possible realizations, but it gives us nice mathematics to think about why does volatility come to price options, right, in general. So let's look at a two-state scenario. So imagine we have two types of assets. Let's say we have a risky assets as a stock, sure, stock, and we have a riskless asset as a bond. So it's right B. Stock pays off high state 120, bad state 90, its current price is 100. And there's a 50-50 chance it can go up or down. Sorry, I'm going to go through this fast because I think you've seen this before. Unless you haven't, right? Please let me know. So 50%, 50%, same thing for bonds. Remember, this 50% was what's called real world probabilities, right? We don't actually observe this, right? We don't actually know what's the likelihood of a stock goes up and down. I'm just telling you beforehand, right? 50-50. And so a bond, because it's riskless, it will always have the same payoff no matter what. So let's just say it's 100, 110. And also it has a starting price of 100. So if you want to put this in percentage terms, we can. This is plus 20%. This is minus 10%. This is plus 10% no matter what, right? All right, so that setup of the question, it should be straightforward, right? Two assets, one risky asset, one riskless asset, the same price. I'm giving you real world probabilities of the likelihood, good state and bad state. For stocks, good states plus 20%, bad states minus 10%. Bond pays off riskless, so it pays off the same no matter what state we are in, good or bad, 10% all the way through. Now, suppose we want to price a call option. So let's call it C. And we know what the call option payoff looks like, right? Again, we're just working with a 2-period model, assuming that it matures in 1 period. It's a max function, S minus K. Let's just use S, okay? Here, max S minus K, where the K is 100. So let me write 100 just to save us writing it again. So in the case in which the underlying asset is in the good state, that's 120. 120 minus 10 gives us a payoff of 20, right? So max function yields a 20. Otherwise, you would not exercise because the payoff would be negative if you did exercise, right? 90 minus 10 is negative 10, so you would not exercise, so that is a 0. So the question you should be asking is, what's the price of the call option? And remember, it's 50-50. And if you're intuitively thinking, it must be just 50 times 20 and 50% times 0, that would be incorrect. The reason is you're just taking the average, weighted average between the two states. But where's the discount rate? Where's the time value of money? Where's the 1 over 1 plus y, right, in your calculations? It's not there, right? It's not there. And this is where the beauty of state pricing comes in, okay? So what we can do now is try to replicate this payoff using a portfolio of assets, right? So I hope you learned from your last semester. If you can find a replicating portfolio, that means we've identified state contingent discount rates, right? Risk neutral probabilities. So if you can replicate the payoff, we can get state contingent discount rates. So that's what we're going to do. We're going to try to replicate this payoff function. So we're going to hold some portfolio of bonds and stocks to get precisely this payoff of 20 and 0, given the upstate or downstate. So you can model this with linear algebra, or you can just solve this by hand. So here you can see that if I hold 120, 110 is the price, is the payoff of the risky asset in the good state, right? So 120 plus 110, 110 is the bond payoff. And I'm going to hold X amount of risky asset, and Y amount of the riskless bond. And it has a payoff of 20. Right, so far so good. In the bad state, the risky asset will have a payoff of 90. I'm still going to hold X, right? Because I have to decide today how much I'm going to hold. But my payoff for bond is still 110 because it's riskless. So some weight for the risky, some weight for the bonds, 2 different states, 2 different payoffs. solve for X and Y. So what I'm doing is I'm trying to replicate precisely this option contract, right? Such that gives me the same payoff, right? Depending on the state. So remember, this is state. These are different state payoffs, right? So if you solve this with linear algebra or just by hand, I'm just going to skip through the math. You will get the solution. So if you want to give you a step, I can give you an extra step. This is equal to 120, 110 divided by 90 plus 110, I believe. So you can double check yourself. So I forget the different minus sign. All right. So if you solve for this, what's interesting is that there's a negative sign there, right? So based on a replicating portfolio that mimics a call option payoff, right? It suggests that call options are inherently leveraged portfolios. You're borrowing some money and then going along in the risky asset. So that's kind of one insight from call options. It's a leveraged portfolio. You can think about it as leveraged. And so it's an additional layer of risk, right? Right, so leveraged positions. Cool. So now we have the portfolio weights, right? And given those portfolio weights, we can now accurately calculate the price of the call option, right? Because we know how much to buy and we know what the prices are for those two assets. We can get the call option price now. So the call option price looks like this, right? We're going to buy 2/3 of this risky asset, 6/11 short, right? Of the riskless asset. They're both priced at 100. So our final call option price is 12.12. You can do the calculations yourself to verify. But that's neat, right? So the trick here, right? If you can replicate the payoff of the contract, right, using short-long portfolio, then you can basically price it. And in fact, if you have enough assets that span the possible states, you can actually price any type of contract, not just a max function. It could be some weird, complicated things depending on the state. That's fine. But ultimately, you have one way to do it now. You replicate it, and you get a price. But that's not the deep insight. The deep insight is if you can replicate, you can find what's called these state contingent discount rates or state risk neutral probabilities. All right, so let's generalize a little bit. So let us generalize this one period example. So suppose we have the same thing. We have S price of 100, but now we're going to say generically it's 100 times 1 plus U. And this is generically 100, 1 plus D. Same thing for the bond. It is 100 worth $100 at time 0, but it can go 100, 1 plus R. Again, R is referring to the riskless rate. So I'm not assigning a value, right? It's not 10% anymore. It's a generic unspecified interest rate. So given that setup, we can do all the calculations again, right? So what does that look like? And we learned from the previous numerical example, this is not how you price, right? This is not how you price call option, where CU is equal to max, right? Blah, blah, blah. It's not that way. You don't do it this way. You have to do it this way, right? We have to use a system of equations. We have the payoff of the options, right? Depending on the state, we have the likelihood of going up and down, and we have interest rates, right? And we solve for X and Y. 2 equations, 2 unknown. So again, I'm not going to walk through the algebra. Just trust me that when you do the solution, it looks like this. So x looks like this, y looks like this. But what's interesting now is that when we calculate the price of the option, so here I'm assuming that the option price, I'm assuming the price of the assets are all equal to 1. You see something interesting. You see a 1 over 1 plus r factored out, right? So now we have a discount rate, right? That's our discount rate. But it's this very precise discount rate. It's the discount rate for riskless assets. So when is the discount rate supposed to be the riskless rate? It's this if the individual is risk neutral, right? This must be true if the investor is risk neutral. You discount everything the same because they interpret the stock and bond the same way. They don't care about risk, they only care about returns, right? But now we have these weights, right? These are our state contingent probabilities or weight or discount factors, right? So in fact, we can rewrite these weights as P here, okay? So this is our final generalized asset pricing methodology now. For a two-period binomial model, we have a generic discount rate, 1 over 1 plus r, and we have these weights P and minus P, where P is written in this way. So your question now may be, where does volatility come in, right? Volatility comes in from the numerator. So you can think about R minus D as something very similar to sigma, right? So if the returns are very, very high, if the it should be not this, yeah, oh, it should be that, but it's probably more clear here, okay? So here and here. So where does volatility factor in? Comes in from D and it comes in from R, right? So if the up state is really, really high, that increases volatility. If the down state is very, very low, that also increases volatility, right? So here we see why volatility can amplify the call option price, right? So you can see that here too, right? Then I guess the denominator. All right, so let's give some numbers here. So in this setting, we assign R as 10%, right? I mean, the previous example, R is 10%. And we also assigned D as 10% or minus 10%, and U as positive 20%, right? So given these three parameters, we can assign our P to be 2/3. Okay, so this is just to show you that with the P here, the investor will value the stock and the bond the same price. Okay, hence it's risk neutral. Hence the name risk neutral. So let's see. So you can work through the calculations here, but I think it's easier if I just showed you the math, okay? I mean, the numeric example. So here we have 1 over 1 plus 10%. That's the discount rate. And then we have 2/3 times 100. The value of the stock, sorry, 120. Plus 1/3, 90. So I'm holding the stock now, right? That's going to give me 100, right? So 2/3, 120, 1/3, 90. That's the weighted average of the likelihood, right? I'm using the 2/3 and the 1/3 as the likelihood now of the state, right? The risk neutral likelihood of the state. 2/3, 120, that's the stock goes up. 1/3, 90, that's when the stock goes down. And I'm discounting it back using 10% to times 0. That gives me a payoff, a price of $100. If I do the same for the bond, so 2/3, 110, right? Plus 1/3, 110. Discount it back to by 10%. That's going to give me 102, right? So using these now, I guess, fake probabilities, right? These aren't real probabilities anymore. There's no 50-50, right? It's 2/3, 1/3. So given these fake probabilities, it's as if the investor is risk neutral, right? Because this person, despite the risk of the stock, this person values the stock and the bond equivalently, and therefore he can discount everything using just R. And that's the conclusion here for the generic. So I'll leave that to you to work through, but you can just empirically verify these numerical examples yourself, right? All right, comments, questions. I hope I didn't lose anyone. I hope this is all review. But I just wanted to point out the risk neutral stuff because when I get to the policy tools part, I need to talk about risk neutral probabilities. Okay. Okay, so the takeaway here is that for option pricing, we need to have a generalized asset pricing model where we think about different states of the world and being able to price assets potentially that pays off in each state of the world. So if the entire market is complete, which means that there's a state, each state has exists an asset that pays off in each state, then you can replicate basically any type of contract, right? Even if it's state contingent. And therefore, you have a generalized asset pricing model, right? So in the option case, you can see if we can replicate the portfolio, to mimic the payoff for different states for the option contract, there must exist risk neutral probabilities. And if you can identify the risk neutral probabilities, you can basically price anything, right? You can price not only options, but you can price whatever types of state contingent claims that you want, right? Let's see if I All right, so let me summarize and then I'll go towards the policy tools slides. All right, so the trick in Black-Scholes and also the binomial tree model, so for those of you who want a historical, why is there two different types of model? Black-Scholes came first. Black-Scholes is continuous time, so that's when there's not discrete periods of time, we have time that's continuous. Black-Scholes uses this trick to replicate the portfolio, the contract payoff of the option in order to price it. Okay, that's the trick. So if you can replicate, there must exist risk neutral probabilities and nothing to do with real world probabilities anymore, right? We don't care about those. Those things become not useful for us for pricing things. So if you can replicate the portfolio, replicate a payoff of the contract or portfolio, then you can price it using risk neutral method, risk neutral asset pricing method. So that's their Nobel Prize contribution. If you can replicate, there must exist risk neutral probabilities. If you can identify these probabilities, you can price anything. Yes, so you must have seen something like this, right? So when you solve for the option contract, this is exactly what you see. You see a discount rate here, right? This is the continuous time, continuous compounding, discounting at just R, right? 1/T for however many periods you want, or continuous periods. Difference, T minus lowercase key. But you're solving for this expression here, right? You're solving for the expected value of the max function, but using the risk neutral probability space, right? It's not the real world space. It's the fake probabilities that you derived, right, from replicating the payoff structure of the contract, the option contract. So the formula that you see here is precisely this, okay? That's just some fancy mathematics that finance people borrow from physics people. All right, so this formula should not be surprising, in fact. For call option, you can see the leverage position, it's a minus K, and you can see what they're doing. They're borrowing the bond, right? That's what the K and expected exponential negative RD, right? That's what they're doing. And they're buying the underlying asset, right? They're going long on the underlying asset. So it's a leveraged contract, hence it's a leveraged, the price reflects the leveragedness of the portfolio, replicating portfolio. All right. So summarize the remarkable result, right? Is that beta is irrelevant. Where is the expected returns in the formula? It's not there, right? That's the Nobel Prize winning finding, is the beta is irrelevant to the price of the option contract. And lastly, it doesn't depend on drift probabilities or change in average value. So there's no drift term. The only thing that matters is the volatility. Right? That's the only thing that matters. The expected returns of the asset doesn't matter. If there's a drift term, if you expect the mean to move, it doesn't appear in the asset pricing model. Right? But the world, of course, is not black scholes, because volatility is, as you probably learned from your other classes, not constant, right? Okay, so if you want to prove that the binomial model converges to black scholes, you can read this book. I'm not going to prove it in class. It's should be quite straightforward if you understand limits, but I'll give you this as a reference. All right, so what I want to do is talk about a policy tool, because some people mentioned to me that they want to be exposed to more of the things that I was exposed to as I worked at the Fed. So let me tell you a tool that was very popular at the Fed. The Fed, as you all know, it's not a hedge fund. Okay, it's not about making money. It's about gauging investor expectations and trying to manage their expectations, and through policy actions, right? Changing interest rates, making sure our announcements don't shock the markets too much, etc. So we have to make sure that if we were to announce something, it's not going to disrupt certain things. So this is where risk neutral probabilities could play potentially an important tool. So the generalized asset pricing model can be used as an important tool. So we can reverse the probabilities of certain states of the world based on options. And we can do this because the likelihood that the market believes for certain states to occur is reflected by the strike price. So if you know the strike price, then you kind of have an idea of what people are betting on, right? So with strike prices and with potential payoffs of the option prices, that can give you some idea of what people believe for how likely a state of the world could occur. So the state of the world is defined as the underlying asset price. Okay, so why this is important for the Fed? Well, imagine we have options on interest rate futures. Right, so futures is you know what it is. It's an exchange of something in the future. So that's people's beliefs about what the Fed might do in the future, specifically cut or increase interest rates. And if you have options on futures, you can now kind of imagine, you can infer what people believe, what possible interest rate prices or values could occur, I guess by quarterly. So depending on the options market. So in the options market, it's by quarter. So at the end of every 6 months, every 3 months. So at the end of March, at the end of June, September, they have options on futures that expire at the end of those quarters. But the example I'm going to give here is on FX futures, right? Just to stay within the realm of foreign currencies. All right, so the question I ask is, can option prices inform us on investor beliefs about future prices of the underlying asset? Why is this important for central banks? Well, because they can characterize the interest rate path. In other words, whether or not the Fed is thinking about cutting or increasing interest rates. But for our class, because we're talking about FX rates, we can just talk about FX prices instead of interest rate. interest rates. Okay, so interest rate contracts a little bit different. So I'm not going to say interest rate prices or anything like that. Let's just stick with FX prices because that's straightforward. Okay, so we can look at options on Euro FX futures as an example. So suppose we are in April and we want to look at options that expire in June. And these futures contracts also settle in June 2024. So we're thinking about people's beliefs of what the price of euros will be at the end of June. And we want to characterize the distribution of their beliefs, right? So give you an idea. I think euro. So here, context, right? So context price of euro in terms of USD is about 1.7 to 1.8, I think. Okay, just give you an idea. So as you can imagine, strike prices could be, very, 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 could be lower than 1.7, could be higher than 1.8, right? So that gives us some space, right, of possible realizations. So the intuition, the strike price defines the set of possible outcomes of what people believe the underlying asset will be in the future. So in the case of euros, it's currently trading at 1.7, 1.8, but it could be the currency could weaken, the currency could strengthen. People place bets based on the options that's being traded out, in the public markets, right? So the option payoffs, therefore, will give us the weights. So we're going to assume, for simplicity, that the payoffs, we're going to calculate the payoffs. That will give us the likelihood that will affect the likelihood that certain states of the world will have more weight or not. I'll give you a numerical example, and I'm going to do it in R code, okay, to show you how it's done. All right, so before diving into the empirical stuff, I'm going to give you the model. All right, the model is very simple, and I don't know if you've seen this generalized pricing model before. So imagine P is just the price of something, this is called the price of the option. But expectation here is we're taking the average over possible different realizations of the payoff of the option contract. So if you were to rewrite this in discrete form, it's the sum of asset or state of the world J, lowercase j to capital J, where pi is the real world probabilities. So real world probabilities, okay? Or physical probabilities, right? Makes sense, right? If we take the average payoff of the asset, that's supposed to give us some value. And then M is supposed to be the state discount rate, right? The state, we have a special name for this in generalized asset pricing, right? It's called stochastic discount factor, right? That's the factor that's supposed to pull it back to time zero, allow us to move the payoff and be able to price it at time zero. Makes sense? So we have a likelihood pi, right, for different states of the world. We have an M, which is a state dependent discount factor that we talked about in option pricing. And then P is the payoff of the option contract. Okay, so far I haven't told you if it's call or put. It doesn't matter. Okay, it doesn't matter if it's call or put. The payoff is the payoff. All right. So what we can do to make if we have a under essentially perfect markets, complete markets, right? I told you before, we need enough assets to span the space of possible states. Suppose we have all that. We can rewrite pi in such a way. So we take the pi j mj and scale it by the sum of pi j mj whatever, and rewrite it this way. So think of pi tilde as just a rescaling by the average of the state discount factor. You don't have to know. You don't have to know precisely why. Just know that we can rewrite these probabilities in terms of this way. Okay, so these are new probabilities. It's easy to check that this is going to be non-negative, less than 1, and will sum to 1. Okay, it behaves much like probabilities, right? And use this pi tilde to now take the average of the payoffs. So now we're working with pi tilde. We can take out this expected discount factor and just think about that as 1 over the risk-free rate. Okay? This is just shorthand way of saying that I'm making the world risk neutral now. It's as if the investor doesn't care about risk anymore, right? Just average returns. So now we have a discount rate, right? It's the risk-free discount rate, which is just expect the average discount rate, right? The average stochastic discount factor. And now we're working with these fake probabilities, right? The fake probabilities that makes the investor behave like they're risk neutral. Okay. So the intuition, of course, okay? So don't worry about the technical stuff. The intuition is that pi is being scaled and adjusted so that the investor is specifically behaving like he's risk neutral. Okay. So this is our now asset pricing model, our ideal world asset pricing model. But we're going to make some assumptions so that we can use this to infer pi, right? Or pi tilde. So either we're backing out pi or pi tilde. We're going to assume that investors are risk neutral, in which case pi equals pi tilde. Okay. So if we were to back out the probabilities, we would be backing out the true pi. Okay. Very strong assumption, but that's what policymakers do, okay, to make their lives easier. The second thing to do is realize that because we're forecasting such a short period of time, just from April to June, right? This is basically close to zero, right? Such a short period of time, we can just think RF is zero, and so this entire term here just goes away. Just to say it's basically 1. So the payoff for each asset I for each state J looks like, sorry, for each asset I, so no J, for each asset I, it's just the average, right? Just the average of the payoff, the max function, and it's just the weights, right? The weighted max function now, given these assumptions. Assuming that RF is close to 0, assume investors are risk neutral, then we can just think about the price of the option as just the weights, pi, and the max function given the different states. And the different states is going to be defined based on the strike prices. So we can write all that in matrix form, right? So we observe prices, right? We know the price of the options. We can go to cmegroup.com and check the prices ourselves and get the prices. We don't observe this. We want to back this out, but we do observe these hypothetical payoffs of the options, assuming these options are exercised at maturity, right? We just calculate max, right? We just calculate max underlying asset price minus strike if it's a call, or K minus underlying asset if it's a put. That's it, right? So that's what this matrix represents. So P1. So let me tell you what these numbers mean. Okay. So imagine we have K assets, so K prices. Each option price has their own. We observe those prices: P1, P2, P all the way to PK. Those are asset prices. Okay. Pi is what we want to derive. Pi 1, pi 2, pi 3, pi k. What is pi? Pi is the likelihood of certain states to come about in the future, right? So if we expect the price of euros to stay constant, we should expect large weight, right, at 1.7, 1.8, and then very small weights everywhere else, right? If we think that's the case. P is the payoff depending on the state that's being realized. So remember, there's K assets, but the states is defined on the strike prices that's available in the market. So imagine there's J states. So P11 is the payoff of asset 1, assuming we are in state 1, right? Pij is payoff of option 1, in the state J. So if 1 through J is increasing values of the underlying asset, so perhaps 1.7, 1.8, 1.9, etc., then 1.9 minus 1 point whatever the strike price is will give us payoff, right? So that's how you calculate that. And the trick here is we include a row of ones that forces the probabilities to sum to 1. Why? Because we can write the price in terms of this way, matrix form, right? Maybe it's easier if I wrote it, yeah, here, I wrote it here, right? If you write the prices and the probabilities in the payoff matrix in matrix form, matrix notation, it looks like P equals capital P times pi, right? Row times column, right? You add it up. And so you weight every state by pi, you add it all up, should give you the average, right? That's what you're doing. Weighted average should equal the price, correct? And to derive the probabilities, you simply take the inverse of P. So here's the artfulness of this, this policy tool. You need to select J such that P is a square matrix, right? That's kind of where the art comes in, right? For this policy tool. You have to be careful when you select the J number. All right, so the trick again, to summarize, we include a row of ones in the P matrix, which will force the pi's to sum to 1. And you can see that here, right? We have a row of ones, and we have a column of pi's, dot, 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 dot. You add up all the pi's, it must sum to 1, right? That has to be true. Price of 1, I forgot 1 here, sorry. So there should be a 1 there, okay? So price of 1. What does this represent? It represents the risk-free asset, right? Risk-free asset pays off 1 no matter what state we are in. The second trick, you have to select J such that P is a square matrix. So that's up to the modeler's discretion. You can choose whatever J you want, okay? You can choose a lower one, a higher one, strike price, and it doesn't matter, okay? So questions on the model. So the model is simply this, right? If we think investors are risk neutral, if we think we're just forecasting just very short term and therefore discount rate doesn't matter, therefore 0% opportunity cost, whatever, then the payoff matrix is simply just the max function depending on the state of realization of the underlying asset as reflected by the strike prices, right? So therefore, pi times P, right? Sum the row, multiply each element of the vector or matrix across the row, down the row, right? That's just summing, right? Weighted sum. The weighted sum across different states must equal to the price of the call option. That's just the definition we have here, right? That's just the definition we have here. Where Q is the probabilities, right? It's just the probabilities. I mean, it's the fake probabilities if you're not risk neutral. If you are risk neutral, then it's the same. Okay, real world and fake probabilities. All right, caution. It doesn't, as I said, it doesn't matter if you use put or call option prices. Just be careful if you put both put and call. There is something called put call parity that makes your assets redundant, right? Given the same strike prices. So how do you deal with scenarios like this? You just drop the redundant asset and shrink the set of possible prices. Again, this is probably obvious once you start trying to do this yourself. Not so obvious if you haven't done it before, right? So let me say that again. In this payoff function, I did not say what the asset was, right? I didn't tell you if it was a call or put. In fact, it doesn't matter. It does not matter. But just realize if the assets that you're dealing with are both put and call and they have the same strike price, it's possible you may have redundant assets. If you have redundant assets, then your P matrix will not be able to invert. You cannot invert it, right? Then you cannot solve for pi. And lastly, I mean, these are all theoretical parts. So it's only accurate if investors are risk neutral, right? I'm assuming that the Q probabilities that I'm calculating is comparable to the real world P probabilities that I don't observe, right? If they are indeed risk neutral, then they are the same. But if they're different, what's going on is that I am overweighting the bad states and underweighting the good states. That's what this adjustment is doing, okay? Just be wary of that. The proof of this is beyond this course, so I won't talk about it, but just let you know that's what's happening. If you take risk neutral probabilities at face value, what's going on is you're overweighting the bad states and underweighting the good states. All right, and then obviously, as I explained earlier, I'm assuming these options are all European and they all have to be exercised at maturity to be calculated. Okay, so let's give you a numerical example. So let's start with option prices. So the top left corner are strike prices. So these are just random numbers, okay? So imagine we have strike price 70 and there's intervals of 5. So 75, 80, 85. Different currencies have different tick marks, so to speak, differences in strikes. So here the tick is 5, 70, 75, 80, 85. I'm assuming that those are the call option prices. I'm only looking at call options to make my life easier, okay? So I don't have to deal with this put call parity stuff. So 10.5, 631, just random numbers. And I can calculate the payoff given the possible future realizations of the underlying asset. So here I'm just copy and pasting the strike price. It's still 70, 75, 80, 85. But I'm just adding one extra possible realization so that this matrix is squared, right? So remember, I have a row of ones for the risk-free asset. So that's 1, 2, 3, 4, 5 states. And then we have 1, 2, 3, 4, 5 assets. So 5 assets, 5 states, square matrix. So this is all call functions. So strike price 70. If the state of the world is 75, 75 minus 5 is 5. 75 minus 5 is 5. If the state of the world is 80, 80 minus 70 is 10, and so forth. Same thing for 75. State of the world is 70. 70 is less than 75, so it's 0. If it's 75, 75 is 0, etc. So I hope these payoffs are obvious, right? I'm just taking the difference between possible future realization in June or whatever, minus the strike price, because I'm working with the call options here. If that difference is positive, that's my payoff. If it's negative, it's going to be 0, which is why you see a diagonal of 0. So you kind of see where the trick comes in, right? I naturally get a linearly independent rows, right? Which forces the matrix to be invertible, and therefore I can calculate the probabilities. So this here, if I add an extra row, so imagine I have a vector like this, and I have one more payoff of 1, right? So this is the price, this is the P. This is capital P, right? And I want to solve for pi, so capital P, pi. And so all I want to do is invert P, so it's P, small p equals pi, right? That's what I want to do. So if I take the inverse of this multiplied by this, that should give me precisely this. And you can double check that this is in fact the probabilities that I do get. So the pi's reference each of the state of the world, right? 70, 75, 80, 85, 90. It's obviously not perfect because The asset price obviously can be between 70 and 75, yes, but this gives us a rough estimate of what people believe the future price will be, right? Make sense? So I'll give you a numerical example. We'll take a break. I mean, a example in R. So let me show you what that looks like. Maybe I hope you can see the text. Maybe I'll zoom in a little bit. Zoom in. Oops. All right, so I work with R. Sorry if you work with Python, just bear with me if you've never seen R before. Um, so I downloaded this data maybe a few days ago. So this is taken from this website at some point in time. Uh, this website. So you can check that. I think that's for Japanese yen, but you can also find euro dollars. So I get that data. I load it in. And let me show you what it looks like. You see option type, C for call options, P for puts, as strike prices. So you can tell that this is for puts. I mean, this is for euros because it goes from something that's crazy like $0.85 per euro all the way to 1 point, sorry, 129. So maybe I miswrote something here. It should be sorry, this should be 107. Let me check right now, okay? Okay. Euro USD. It is yeah, see 1.08. So let's go back. So let me just tell you again, let me show you the data. Strike price, highs and lows change over the day, or I forget, maybe it's a day or hours, I'm not sure. Bid price, ask price. So obviously, if it's missing a bid price, probably not so liquid, so maybe nobody's trading it. Volume, open interest, just contracts outstanding. Premium. So I'm going to use the bid price and then maybe filter using volume. Okay, so that's kind of obvious, I think. So again, to keep my life simple, I'm not going to think of and I don't have to think about put call parity. I'm just going to use options, call options. Okay, so option type equals C. I'm only going to think about the most liquid, the ones that are trading. If it's being traded, I suspect that those being traded are what people believe. Okay, if it's not being traded, I think it's just speculation. Probably 0% likely. So restricting myself to only call options and only those with positive trading volume. Here I am filtering on. So this doesn't matter because I'm only doing call options. This is only if there's two of the same strikes. Choose the option with the most open interest. So I'm not gonna. Doesn't matter. Doesn't do anything here because I'm only doing with call options. Here I'm gonna find the longest consecutive chain of strike prices to define my space. Okay, so if it's between, so there could be gaps in strike prices. I'm just finding the longest consecutive numeric numbers of strike prices, right? So if it's 1.08, then 1.085 and so forth, right? Because it's by 0.05005 ticks. Okay. I mean, I'm happy to share this later, or you can watch the YouTube later. But anyways, I'm defining the space. So let me say it again. I'm defining the space of possible strike prices that could take place in the future in the June. And then I'm going to find the strikes, find the prices. And as you can see, based on this row here, I'm adding one additional strike at the last column, right? So it's a square matrix. And for prices, I'm going to take take prices, and then I'm going to merge prices with the strikes. All right, so this is a little bit too hard to explain. what I'm doing is matching, I'm getting the combination of strikes versus future possible price of realization. So if there's five possible, if there's five possible strikes and there's five possible realizations, it's 5 by 5, right? So every strike, so every strike has five possible outcomes I need to evaluate the payoff, right? I'm trying to calculate the payoff matrix. So five strikes with five future prices is 5 times 5, right? That's what I'm doing. Okay, so you can see here, if the option type is put, it's strike minus prices. If it's a call, it's prices minus strike. If the payoff is negative, it's 0. So I hope that's obvious. And then I am converting it to a payoff matrix. All right, so let me show what that looks like. So let me rerun everything. And all right, so do you see the matrix? It's not, maybe I do it like that, maybe. Oops, it doesn't like that. All right, so maybe just that. Okay. All right, so that's the matrix. Note the row of ones, right? Note the row of ones. Okay, and the strike prices are in the row names. 1.07, 1.05, all the way to 1.135. And this is the 15th row. So it's a 15 by 15 row, I believe. Right? DIM means dimension. So it's 15 by 15. It's invertible. I can take the determinant. So it's non-zero. Cool. And so I can solve for pi. Cool. So I'm just doing matrix multiplication here. And I can plot it. Margins. Figure. Okay. Maybe if I did this. All right, fine. I'll just show you the pi. Okay, cool. Those are the probabilities. All right, I can plot it. I can't plot it here for some reason, but I plot it here. You can see that there's a 40% chance that everyone believes the euro basically stays at 1.07, right? Looks like it's a little bit depreciated now, but it could strengthen by 2 ticks in June. Okay. Everything else you can see you can add up the probabilities just to prove that it sums to 1. Let me show you. It does sum to 1. I hope. Cool. Sums to 1. And yes, and you can see the other strikes also have some positive weight, but they're quite small. Right. So anyways, I hope that was an interesting exercise for you, and maybe you can go ahead and use this to evaluate the likelihood of other types of assets. So remember, this is just for euros. Okay. What's more interesting is actually, again, things that people actually predict a possible sharp change, like whether or not the FOMC, the governing body that determines interest rates in the US, decides to cut or increase interest rates. And this is one way to back out what the market thinks the FOMC will do, right? But you have to look at options on contracts for interest rates, right? For the overnight lending rate. Okay, so that's basically it for options. And then let me double check. Well, anyways, I'll summarize again if there's anything left over after the break. So let's take a 10-minute break, and then you can ask me questions if you have stuff, right? No quiz. Okay. I understand. Give me a minute. Yeah, I'll think about it. Yeah, yeah.
So if the Fed increase the rates, the fund floor is the will outflow from China to US.
The funds, sorry.
Yeah, the cash because there is a high interest rate in America, so the fund will transfer
Oh,
from China
um,
to America, and the
if
different
it depends on if those funds are allowed to move, right? You have capital controls in China. So I don't know, right? Because the whole
that will make the currency depreciate.
If
The RMB
yeah,
will,
I mean if the US interest rates go up, yes.
Yeah.
Yes.
yes, and the asset price in China will decrease. So the asset price, the E will goes down. So this is the minus, the negative.
Okay, let me see.
If the underlying asset is domestic assets.
Oh. You're saying this should be negative.
Here.
Oh, here.
Yeah.
Oh, okay. So
E will increase.
yes,
Depreciate.
yes. So it should be
The financial asset in China will, its price will go down. So because the if there is no control of funds flow, then the funds will go from China to America.
so you're saying here it's the US dollar, that's the foreign
Yeah.
currency, and foreign interest rates go up,
Yeah,
then
the
E
exchange rate
should
goes up
go up.
and
That means the
RMB depreciates.
yes. Okay. So it's not the price of the okay.
And if once get away from China, so they will sell the assets. So the assets price will goes down because there is so many people want to sell them.
Hmm.
It's just like
Okay. Okay.
I guess.
Uh
So I want to make it clear that which underlying assets is here, and the domestic asset or foreign asset.
yeah, I think it should be the foreign asset. I mean, it should be
So if it is foreign assets
mhm.
and the foreign interest rate goes up, and so the asset price will goes down. It's very clear.
Okay.
So we don't have to talk about the exchange.
Okay, you're right. Yeah, you're right. Yeah. Yeah, I'm thinking too much. I'm thinking too much. Okay, yeah.
Okay.
Yeah, you're right. Okay, yeah. Foreign prices. Okay, so the more I think about this, the more I'm confused. I think the best way to think about this is just to interpret foreign interest rates like dividends. I think that's the best explanation. So, as I said already, so let me revisit my notes. So let's disregard what I said here. And let's just think about foreign interest rates like dividends. So if you don't have to deliver the dividends, or if the dividends occur before the actual delivery, right? Then the price of the asset you have to deliver is going to be lower than before, right? So with higher interest rates, let's think about higher dividends, more cash emissions before delivery, then that's going to negatively impact the call option price. So yeah, right. So if more of the interest payments occur beforehand, right? You don't have to deliver those interest payments. You just have to deliver what's left, right? Principals in the future. And so if you have more of those interest payments occurring before delivery, then that means the price of the underlying asset doesn't have to be as high as before, right? If you increase those interest payments before delivery. I think that's the way to think about it. But you could also think about it in the other way that somebody suggested to me here. If you have higher foreign interest rates, that just naturally means that asset prices are dropping, right? There's an inverse relation, in which case, with lower asset prices, then obviously that's going to undermine the call option value. I hope that's clear. Sorry about that ambiguity. Let me see if I wrote something here that might emphasize my takeaway here. Okay. Yes. So I think that's what I said, right? If you think about foreign interest rates as dividends, the underlying from the call option's perspective, the accumulated dividends are not sold to the counterparty. And so the price of the call option is lower if more of those dividends are emitted before delivery. The same concept for put options. So if you do not have to pay the cumulative dividends from time t to big T, but you have to deliver it later on, then it's going to increase the value, right? For the put position. All right, so I think this is the better interpretation, but of course the other interpretation is also, I think, makes sense too. Forget my comment on UIP. I'm probably thinking too much. Okay, so let me go through these questions quickly because I have them available. So these are practice problems just to test your understanding of futures options contracts. So question 1 asks the question: to initiate an arbitrage trade, if futures contract is underpriced, the trader should do which of the following. So we can just write out the equation, right? So it's like R minus D, R minus D, maybe T minus T, right? That's our futures spot parity. But if you have a futures contract that's lower than that, a future price that's lower than that, then you want to, I believe, short the asset, right? And invest in the risk-free rate. So maybe it becomes clearer if I rewrite everything in terms of UIP. So maybe I write E 1 plus R over 1 plus star, right? So I'll move this over to the other side. And I can move the E onto the other side too. That means I borrow I borrow R star and I invest in a risk-free rate, right? I borrow R star, so I short the asset and I invest in the risk-free rate, which is this thing. So B is the answer. Or you can use the cost of carry explanation the previous slides. For question 2, which of the following is the difference between futures and forward contracts? Standardized, sure. Over-the-counter instruments, sure. Larger than, okay, let me see. Between futures and forward contracts. Futures contracts are standardized, yes. Over-the-counter, no. Futures are centralized on a platform, and there's the market maker decides who your counterparty is. So it's not over the counter. You don't have to find your counterparty yourself. So B is wrong. Larger than forward contracts, definitely no. Futures contracts are standardized, so they're palatable for every type of investors. And these larger contracts, most likely is because you need to go find your counterparty yourself. So less likely to be larger than forward contracts. So the answer is A. Oil futures might be higher than the spot price. So that means F is greater than S. What does that mean? It means that this exponential part, right, is deflating, right? It's a negative sign here. So that means, how does it deflate? It deflates because, not because the cost of borrowing is increasing, but because it's so inconvenient to hold, right? And so inflating. It's inflating. Sorry, it's inflating it, right? So if F is greater than S, it implies that, move this, it's not this thing, wait. It means that this component is very large, right? So it's inflating S so that the price of F is super large. So either R is large or those convenience parameters are very low, or there's a cost of storage, right? Plus S, right? S is large or R is large. So there are more benefits than costs of holding onto the asset? No, right? There are more costs than benefits to holding onto the asset? Yes, right? Because I said those costs are larger. So it elevates the S up. And therefore, right, and it's not the reverse of contango, whatever that means. Contango is, I believe, precisely this. No, it's not. Nothing to do with contango. Okay, contango is expectations, right? So nothing to do with contango. All right, so that's the questions I gave you. So I hope you have solid understanding of futures and options now. And let's move on to the lecture of the day, which is on Bitcoin. So why should you care? Last time I checked, CFA exam does involve understanding of blockchain. I don't know the state of blockchain in Hong Kong very well, but I am very skeptical of this asset space, and I'm gonna basically convey that skepticism to you over the next, I guess, 30 to 40 minutes. I can see why blockchain is important, because it's one way to track assets without storing that information in a central location. So remember what blockchain is supposed to do. It's supposed to use cryptography so that you can decentralize information. That's the key takeaway here, okay? Whatever they talk about, tokenization, whatever that stuff, if it's not decentralized with cryptography, you might as well just put that file in Excel on a computer somewhere and then password protect it, right? What's the difference? So the benefits comes from the fact that the information is decentralized. You have basically backups upon backups upon backups across a network of computers. And that means it's also very hard to manipulate this data set. And you have to utilize cryptography to make it secure. Any other people selling you other types of blockchain that doesn't have these features, I think is kind of a waste of time or a scam. But assuming that you have this need to decentralize information, uh, makes this information very hard to change. For example, money, tracking money. I can see why central banks may be looking into this technology, so to speak. All right, so again, it's not just cryptocurrency that we're necessarily, I mean, currencies that we're necessarily tracking. It can also be other types of assets. People have tried to put artwork on blockchain, like this latest craze with NFTs, non-fungible tokens, which is absurd. There's also people trying to tokenize real estate deeds. I don't know why. People are trying to tokenize stocks, which I can think makes sense as well. It's hard to track precisely who owns what, honestly. If you ask like investor relations of companies who owns what stock, they probably don't have a good idea of that. Um, Especially in the US, if stock is highly the ownership of stock is highly dispersed in the US. And so it's hard to tell who owns what, right? China, on the other hand, is different. They have block placements of stocks all the time, and I think it's just really a large family of owners from most publicly traded Chinese companies. But for countries like the US that have dispersed ownership, I think tracking assets is probably an important thing to think about. Um, Okay, so of course, not necessarily currencies. You can track stocks, real estate, any sort of commodities. You can think about diamonds as well, right? It's hard. You want to make forgery of diamonds. So if you know that your diamonds are so-called uh not blood diamonds, right? Maybe people want to wash those diamonds, money laundering it. Then blockchain perhaps can mitigate that laundering effect if they track certain to make it very difficult to change the database, right? So that's one way to deal with it. All right, so that's the asset tracking information aspect. So other reasons why you might want to use blockchain is the following. Maybe you want to raise capital, right? So maybe you've been paying attention since 2017. Lots and lots and lots of companies tries to raise capital by issuing, rather than stock, they issued tokens or coins. So in 2017, right, there was a massive surge of people on the so-called Ethereum blockchain. They tried to issue tokens for investors uh, in exchange for the future in which they can utilize this token for some kind of service, or they buy it back. But the latter sounds like an asset, right? In which case it should be regulated. But it turns out all this ICO craze was just full of scams. As far as I know, I don't even know a successful ICO scenario. Maybe you can tell me if there was a successful one. Initial exchange offerings is the same idea. You're just raising capital for like private private companies, but rather than issuing coins, like issuing stock, they give out, you somehow acquire these coins, and when the coins gets listed, you have the ability to liquidate your holdings. That's why it's called initial exchange offerings, because once the coin gets listed, not like a stock sense, but in terms of being traded, then insiders get to liquidate their position, right? So in other words, one way for insiders to take advantage of the people who are trading these currencies on the secondary market. All right, so that's my understanding of what has been happening in this space in terms of finance. I don't know the technology. The technology is Bitcoin, I think, is the extent of my understanding of the technology. Beyond those things, like beyond like beyond like what do you call it? Lightning network, right? Those things. I think I don't know what the benefits are. I know that Ethereum has code being written on the blockchain and they can be executed, but I don't think that's very, how you say, the code is law, right? So if you make a mistake, then your entire system is messed up. So I don't see the benefit of having the code on blockchain, especially if it's very difficult to change the blockchain. So I'll show you a video to explain to you just how difficult it is to trade, to buy a coin, okay, or to exchange a coin. And imagine if that's the code, right? Then it's going to take forever to run potentially. Okay, my understanding of the benefits of cryptocurrency up to this point is that this technology is very easy to circumvent laws. Okay, so there's many conversations among policymakers how because of cryptocurrencies, North Korea has been able to finance its nuclear program. Same thing with Iran. So what it's good at is exactly why what it's good at is precisely what the technology is good at. It's the cryptography part that makes it extremely difficult to track, and we don't know who's laundering what, and it takes like a whole industry of teams and so forth to basically reverse engineer where the transactions are taking place. I can only see negative aspects of uh, cryptocurrencies, but if you think about it from the perspective of capital mobility, by all means, I agree. If you're in a country that's war torn and you want to transfer your assets, you don't want to carry luggages of cash or gold, then perhaps cryptocurrencies is the way to go. You sell all your assets for Bitcoin, you move to a different country, you log on to an exchange, and you sell all your stuff for cash. So in the end of the day, it's just an intermediary vehicle currency so that you can move your assets to different countries. There's no longer these national boundaries doesn't apply to you anymore, right? That's the only benefit I see here. All right, so now you know my opinion. But my job is to, if you don't know anything about it, to give you a taste of what's the technology about. So I'm going to play this video, and I hope it has sound. Let me check the sound. Okay, cool. So let me play it for you. Sorry, you have to deal with the advertisement. All right. What's the impact of Bitcoin? There's just one third of Bitcoin. It's a whole digital currency with no government to issue it, and that no banks need to manage accounts and verify transactions. And also that no one really knows who invented it. And yet, many people don't know the answer to this question. It's not in full. To get there, and to make sure that the technical details underlying the answer actually feel motivated, what we're going to do is walk through step by step how you might have invented your own version of Bitcoin. We'll start with you keeping track of payments with your friends using a communal ledger. And then as you start to trust your friends and the world around you less and less, and if you're clever, to bring in a few ideas from cryptography to help circumvent the need for trust, what you end up with is what's called a cryptocurrency. You see, Bitcoin is just the first implemented example of a cryptocurrency. And now there are thousands more on exchanges with traditional currencies. Walking the path of inventing your own can help to set the foundations for understanding some of the more recent players in the game and recognizing when and why there's room for different design choices. In fact, one of the reasons I chose this topic is that in the last year, there's been a huge amount of attention and investment and, well, honestly, hype directed at these currencies. And I'm not going to comment or speculate on the current or future exchange rates, but I think we'd all agree that anyone looking to buy a cryptocurrency should really know what it is. And I don't just mean in terms of analogies with vague connections to gold mining. I mean an actual direct description of what the computers are doing when we send, receive, and create cryptocurrencies. One thing worth stressing, by the way, is that even though you and I are going to dig into the details here, and that takes meaningful time, you don't actually need to know those details if you just want to use the cryptocurrency.
Just like you don't need to know the details of what happens under the hood when you swipe a credit card. Like any digital payment, there's lots of user-friendly applications that let you just send and receive the currencies without thinking about what's going on. The difference is that the backbone underlying this is not a bank that verifies transactions. Instead, it's a clever system of decentralized trustless verification based on some of the math born in cryptography. But to start, I want you to actually set aside the thought of cryptocurrencies and all that just for a few minutes. We're going to begin the story with something more down to earth: ledgers and digital signatures. If you and your friends exchange money pretty frequently, paying your share of the dinner bill and such, it can be inconvenient to exchange cash all the time. So you might keep a communal ledger that records all of the payments that you intend to make some point in the future. Alice pays Bob $20, Bob pays Charlie $40, things like that. This ledger is going to be something public and accessible to everyone, like a website where anyone can go and just add new lines. And let's say that at the end of every month, you all get together, look at the list of transactions, and settle out. If you spent more than you received, you put that money in the pot. And if you received more than you spent, you take that money out. So the protocol for being part of this very simple system might look like this. Anyone can add lines to the ledger, and at the end of every month, you all get together and settle out. Now, one problem with a public ledger like this is that anyone can add a line. So what's to prevent Bob from going and writing Alice pays Bob $100 without Alice approving? How are we supposed to trust that all of these transactions are what the sender meant them to be? Well, this is where the first bit of cryptography comes in: digital signatures. Like handwritten signatures, the idea here is that Alice should be able to add something next to that transaction that proves that she has seen it and that she's approved of it. And it should be infeasible for anyone else to forge that signature. At first, it might seem like a digital signature shouldn't even be possible. I mean, whatever data makes up that signature can just be read and copied by a computer. So how do you prevent forgeries? Well, the way this works is that everyone generates what's called a public key private key pair, each of which looks like some string of bits. The private key is sometimes also called a secret key, so that we can abbreviate it as SK while abbreviating the public key as PK. Now, as the name suggests, this secret key, it's something you want to keep to yourself. In the real world, your handwritten signature looks the same no matter what document you send. But a digital signature is actually much stronger because it changes for different messages. It looks like some string of ones and zeros, commonly something like 256 bits. And altering the message even slightly completely changes what the signature on that message should look like. Speaking a little more formally, producing a signature involves a function that depends both on the message itself and on your private key. The private key ensures that only you can produce that signature, and the fact that it depends on the message means that no one can just copy one of your signatures and then forge it on another message. Hand in hand with this is a second function used to verify that a signature is valid. And this is where the public key comes into play. All it does is output true or false to indicate if this was a signature produced by the private key associated with the public key that you're using for verification. I won't go into the details of how exactly both these functions work, but the idea is that it should be completely infeasible to find a valid signature if you don't know the secret key. Specifically, there's no strategy better than just guessing and checking random signatures, which you can check using the public key that everyone knows. Now think about how many signatures there are with a length of 256 bits. That's 2 to the power of 256. This is a stupidly large number. To call it astronomically large would be giving way too much credit to astronomy. In fact, I made a supplemental video devoted just to illustrating what a huge number this is. Right here, let's just say that when you verify that a signature against a given message is valid, you can feel extremely confident that the only way someone could have produced it is if they knew the secret key associated with the public key you used for verification. Now, making sure that people sign transactions on the ledger is pretty good, but there's one slight loophole. If Alice signs a transaction like Alice pays Bob $100, even though Bob can't forge Alice's signature on a new message, he could just copy that same line as many times as he wants. I mean, that message signature combination remains valid. To get around this, what we do is make it so that when you sign a transaction, the message has to also include some sort of unique ID associated with that transaction. That way, if Alice pays Bob $100 multiple times, each one of those lines on the ledger requires a completely new signature. All right, great. Digital signatures remove a huge aspect of trust in this initial protocol. But even still, if you were to really do this, you would be relying on an honor system of sorts. Namely, you're trusting that everyone will actually follow through and settle up in cash at the end of each month. What if, for example, Charlie racks up thousands of dollars in debt and just refuses to show up? The only real reason to revert back to cash to settle up is if some people, I'm looking at you, Charlie, owe a lot of money. So maybe you have the clever idea that you never actually have to settle up in cash as long as you have some way to prevent people from spending too much more than they take in. Maybe what you do is start by having everyone pay $100 into the pot, and then have the first few lines of the ledger read, Alice gets $100, Bob gets $100, Charlie gets 100, etc. Now, just don't accept any transactions where someone is spending more than they already have on that ledger. For example, if the first two transactions are Charlie pays Alice $50 and Charlie pays Bob $50, if you were to try to add Charlie pays you $20, that would be invalid as if he had never signed it. Notice, this means that verifying a transaction requires knowing the full history of transactions up to that point. And this is more or less also going to be true in cryptocurrencies, though there is a little room for optimization. What's interesting here is that this step removes the connection between the ledger and actual physical US dollars. In theory, if everyone in the world was using this ledger, you could live your whole life just sending and receiving money on this ledger without ever having to convert to real US dollars. In fact, to emphasize this point, let's start referring to the quantities on the ledger as ledger dollars, or LD for short. You are, of course, free to exchange ledger dollars for real US dollars. For example, maybe Alice gives Bob a $10 bill in the real world. In exchange for him adding and signing the transaction, Bob pays Alice 10 ledger dollars to this communal ledger. But exchanges like that, they're not going to be guaranteed by the protocol. It's now more analogous to how you might exchange dollars for euros or any other currency on the open market. It's just its own independent thing. This is the first important thing to understand about Bitcoin or any other cryptocurrency. What it is a ledger. The history of transactions is the currency. Of course, with Bitcoin, money doesn't enter the ledger with people buying in using cash. I'll get to how new money enters the ledger in just a few minutes. But before that, there's actually an even more significant difference between our current system of ledger dollars and how cryptocurrencies work. So far, I've said that this ledger is in some public place, like a website where anyone can add new lines. But that would require trusting a central location, namely, who hosts the website? Who controls the rules of adding new lines? To remove that bit of trust, we'll have everybody keep their own copy of the ledger. Then when you want to make a transaction, like Alice pays Bob 100 ledger dollars, what you do is broadcast that out into the world for people to hear and to record on their own private ledgers. But unless you do something more, this system is absurdly bad. How could you get everyone to agree on what the right ledger is? When Bob receives a transaction, like Alice pays Bob 10 ledger dollars, how can he be sure that everyone else received and believes that same transaction? That he'll be able to later on go to Charlie and use those same 10 ledger dollars to make a transaction? Really, imagine yourself just listening to transactions being broadcast. How can you be sure that everyone else is recording the same transactions and in the same order? This is really the heart of the issue. This is an interesting puzzle. Can you come up with a protocol for how to accept or reject transactions and in what order, so that you can feel confident that anyone else in the world who's following that same protocol has a personal ledger that looks the same as yours? This is the problem addressed in the original Bitcoin paper.
Welcome to a new edition of Capital Ideas Podcast. Listeners can expect to hear real stories from real investment professionals. We are going to discuss ideas and conviction. Invest 30 minutes in an episode today.
At a high level, the solution that Bitcoin offers is to trust whichever ledger has the most computational work put into it. I'll take a moment to explain exactly what that means. It involves this thing called a cryptographic hash function. The general idea that we're built to is that if you use computational work as a basis for what to trust, you can make it so that fraudulent transactions and conflicting ledgers would require an infeasible amount of computation to bring about. Again, I'll remind you that this is getting well into the weeds beyond what anyone would need to know just to use a currency like this. But it's a really cool idea. And if you understand it, you understand the heart of Bitcoin and of other cryptocurrencies. So first things first, what's a hash function? The inputs for one of these functions can be any kind of message or file. It really doesn't matter. And the output is a string of bits with some kind of fixed length, like 256 bits. This output is called the hash or the digest of the message. And the intent is that it looks random. It's not random. It always gives the same output for a given input. But the idea is that if you slightly change the input, maybe editing just one of the characters, the resulting hash changes completely. In fact, for the hash function that I'm showing here, called SHA-256, the way the output changes as you slightly change that input is entirely unpredictable. You see, this is not just any hash function. It's a cryptographic hash function. That means it's infeasible to compute in the reverse direction. If I show you some string of ones and zeros and ask you to find an input so that the SHA-256 hash of that input gives this exact string of bits, you will have no better method than to just guess and check. And again, if you want to feel for how much computation would be needed to go through 2 to the 256 guesses, just take a look at the supplement video. I actually had way too much fun learning that thing. You might think that if you just really dig into the details of how exactly this function works, you could reverse engineer the appropriate input without having to guess and check. But no one has ever figured out a way to do that. Interestingly, there's no cold, hard, rigorous proof that it's hard to compute in the reverse direction. And yet, a huge amount of modern security depends on cryptographic hash functions and the idea that they have this property. If you were to look at what algorithms underlie the secure connection that your browser is making with YouTube right now, or that it makes with your bank, you will likely see the name SHA-256 show up in that. For right now, our focus will just be on how such a function can prove that a particular list of transactions is associated with a large amount of computational effort. Imagine someone shows you a list of transactions, and they say, hey, I found a special number, so that when you put that number at the end of this list of transactions and apply SHA-256 to the entire thing, the first 30 bits of that output are all zeros. How hard do you think it was for them to find that number? Well, for a random message, the probability that a hash happens to start with 30 successive zeros is 1 in 2 to the 30, which is about 1 in a billion. And because SHA-256 is a cryptographic hash function, the only way to find a special number like that is just guessing and checking. So this person almost certainly had to go through about 1 billion different numbers before finding this special number. And once you know that number, it's really quick to verify. You just run the hash and see that there are 30 zeros. So in other words, you can verify that they went through a large amount of work, but without having to go through that same effort yourself. This is called a proof of work. And importantly, all of this work is intrinsically tied to the list of transactions. If you change one of those transactions, even slightly, it would completely change the hash. So you'd have to go through another 1 billion guesses to find a new proof of work, a new number that makes it so that the hash of the altered list, together with this new number, starts with 30 zeros. So now think back to our distributed ledger situation. Everyone is there broadcasting transactions, and we want a way for them to agree on what the correct ledger is. As I said, the core idea behind the original Bitcoin paper is to have everyone trust whichever ledger has the most work put into it. The way this works is to first organize a given ledger into blocks, where each block consists of a list of transactions together with the proof of work. That is a special number so that the hash of the whole block starts with a bunch of zeros. For the moment, let's say that it has to start with, 60 zeros, but later we'll return back to a more systematic way you might want to choose that number. In the same way that a transaction is only considered valid when it's signed by the sender, a block is only considered valid if it has a proof of work. And also, to make sure that there's a standard order to these blocks, we'll make it so that a block has to contain the hash of the previous block at its header. That way, if you were to go back and change any one of the blocks, or to swap the order of two blocks, it would change the block that comes after it, which changes that block's hash, which changes the one that comes after it, and so on. That would require redoing all of the work, finding a new special number for each of these blocks that makes their hashes start with 60 zeros. Because blocks are chained together like this, instead of calling it a ledger, it's common to call it a blockchain. As part of our updated protocol, we'll now allow anyone in the world to be a block creator. What that means is that they're going to listen for transactions being broadcast, collect them into some block, and then do a whole bunch of work to find a special number that makes the hash of that block start with 60 zeros. Then once they find it, they broadcast out the block that they found. To reward a block creator for all this work, when she puts together a block, we'll allow her to include a very special transaction at the top of it, in which she gets, say, 10 ledger dollars out of thin air. This is called the block reward, and it's an exception to our usual rules about whether or not to accept transactions. It doesn't come from anyone, so it doesn't have to be signed. And it also means that the total number of ledger dollars in our economy increases with each new block. Creating blocks is often called mining, since it requires doing a lot of work, and it introduces new bits of currency into the economy. But when you hear or read about miners, keep in mind that what they're really doing is listening for transactions, creating blocks, broadcasting those blocks, and getting rewarded with new money for doing so. From the miner's perspective, each block is kind of like a miniature lottery, where everyone is guessing numbers as fast as they can until one lucky individual finds a special number that makes the hash of the block start with many zeros, and they get the reward. For anyone else who just wants to use this system to make payments, instead of listening for transactions, they all start listening just for blocks being broadcast by miners and updating their own personal copies of the blockchain. Now, the key addition to our protocol is that if you hear two distinct blockchains with conflicting transaction histories, you defer to the longest one, the one with the most work put into it. If there's a tie, just wait until you hear an additional block that makes one of them longer. So even though there's no central authority and everyone is maintaining their own copy of the blockchain, if everyone agrees to give preference to whichever blockchain has the most work put into it, we have a way to arrive at decentralized consensus. To see why this makes for a trustworthy system, and to understand at what point you should trust that a payment is legit, it's actually really helpful to walk through exactly what it would take to fool someone using this system. Maybe Alice is trying to fool Bob with a fraudulent block. Namely, she tries to send him one that includes her paying him 100 ledger dollars, but without broadcasting that block to the rest of the network. That way, everyone else still thinks that she has those 100 ledger dollars. To do this, she would have to find a valid proof of work before all of the other miners, each working on their own block. And that could definitely happen. Maybe Alice just happens to win this miniature lottery before everyone else. But Bob is still going to be hearing the broadcasts made by other miners. So to keep him believing this fraudulent block, Alice would have to do all of the work herself to keep adding blocks on this special fork in Bob's blockchain that's different from what he's hearing from the rest of the miners. Remember, as per the protocol, Bob always trusts the longest chain that he knows about. Alice might be able to keep this up for a few blocks if just by chance she happens to find blocks more quickly than the rest of the miners on the network all combined. But unless she has close to 50% of the computing resources among all of the miners, the probability becomes overwhelming that the blockchain that all of the other miners are working on grows faster than the single fraudulent blockchain that Alice is feeding to Bob. So, after enough time, Bob's just going to reject what he's hearing from Alice in favor of the longer chain that everyone else is working on. Notice, that means that you shouldn't necessarily trust a new block that you hear immediately. Instead, you should wait for several new blocks to be added on top of it. If you still haven't heard of any longer blockchains, you can trust that this block is part of the same chain that everyone else is using. And with that, we've hit all the main ideas. This distributed ledger system, based on a proof of work, is more or less how the Bitcoin protocol works, and how many other cryptocurrencies work. There's just a few details to clear up. Earlier, I said that the proof of work might be to find a special number so that the hash of the block starts with 60 zeros. Well, the way the actual Bitcoin protocol works is to periodically change that number of zeros so that it should take, on average, 10 minutes to find a new block. So as there are more and more miners added to the network, the challenge actually gets harder and harder in such a way that this miniature lottery only has about one winner every 10 minutes. Many newer cryptocurrencies actually have much shorter block times than that. And all of the money in Bitcoin ultimately comes from some block reward. In the beginning, these rewards were 50 Bitcoin per block. There's actually a great website you can go to called Block Explorer that makes it easy to look through the Bitcoin blockchain. And if you look at the very first few blocks on the chain, they contain no transactions other than that 50 Bitcoin reward to the miner. But every 210,000 blocks, which is about every 4 years, that reward gets cut in half. So right now, the reward is 12.5 Bitcoin per block. And because this reward decreases geometrically over time, it means there will never be more than 21 million Bitcoin in existence. However, this doesn't mean that miners will stop earning money. In addition to the block reward, miners can also pick up transaction fees. The way this works is that whenever you make a payment, you can purely optionally include a little transaction fee with it that's going to go to the miner of whichever block includes that payment. The reason you might do that is to incentivize miners to actually include the transaction to be broadcast into the next block. You see, in Bitcoin, each block is limited to about 2,400 transactions, which many critics argue is unnecessarily restrictive. For comparison, Visa processes an average of about 1,700 transactions per second, and they're capable of handling more than 24,000 per second. This comparatively slow processing on Bitcoin makes for higher transaction fees, since that's what determines which transactions miners choose to include in a new block. All of this is far from a comprehensive coverage of cryptocurrencies. There are still many nuances and alternate design choices that I haven't even touched. But my hope is that this can provide a stable wheat-but-why style tree trunk of understanding for anyone looking to add a few more branches with further reading. Like I said at the start, one of the motives behind this is that a lot of money has started flowing towards cryptocurrencies. And even though I don't want to make any claims about whether that's a good or bad investment, I really do think that it's healthy for people getting into the game to at least know the fundamentals of the technology. As always, my sincerest thanks to those of you making this channel possible.
Alrighty, so you can rewatch that on your own time of the technical details. What I want to conclude for today is to actually show you a transaction taking place. So I gave you some instructions to download your own wallet to play with fake Bitcoin. So like all programming, it's good practice to have what's called a testing place to test your code. And Bitcoin also has a so-called test net in which you can play with dummy money. And with certain wallets allow you to make exchanges and transactions with this dummy money. And that's exactly what I'm going to show you now, just to show you, indeed, it takes about 10 minutes for transactions to be verified. So let me show you here. All right. So let me go to this website here. I mean, you can do this yourself right now if you're bored. Good. I'll save that. Okay, so it's like this. So it's called a faucet because, like a faucet, you can just get money, basically for free. This money, of course, is worthless by definition because the people who run this net can zero out holdings anytime they want. So I guess based on that fact, it should be worth nothing. But anyways, we can go ahead and send ourselves some money. So I typed in my BTC, TBTC, so it's fake Bitcoin address. So I wrote it here. I'm gonna give myself some money. I'm gonna send it to myself. Hopefully it goes through. It's not working. Okay, let me get another address. Hold on. Let's see. Doesn't like it, huh? Let me try a different browser. Okay, it seems like this one's better. Try copy and pasting this. Let me try to find another faucet. Sorry. Weird. So maybe this one. All right, never mind. I apologize for that. Okay, I guess I'll show you next week on that. So maybe I'll just conclude with some uh let me talk about valuation. Okay. As I said already, um I believe Bitcoin does have value in the extreme cases in which you're trying to escape tyranny and oppression. And you want to move your money out of certain countries that don't allow to have restrictions on capital flows. So imagine if you're a Russian oligarch trying to move money out. Obviously, Bitcoin cryptocurrency is probably the way to go. They probably freeze all your accounts if you're not in line with Putin's politics, in which case you're in big trouble. So in that sense, Bitcoin is great because nobody can censor you. There's not part of the banking networks. If you try, for example, if you try to donate money to like people who are political prisoners, certain banks could stop you. The U.S. government, for example, could ban you, can instruct banks not to accept transfers to certain charities because they're affiliated with political, uh, you know, not politically people who are politically persecuted by the U.S. something like that. Uh, in that sense, also it's borderless because national boundaries doesn't matter as long as you have a computer with internet access. You should be able to make Bitcoin transactions. More importantly, there's transparency in monetary policy, right? As you saw from the video, right? The monetary policy is written in code. There's only a maximum of 21 million units of Bitcoin. Bitcoin the block increases by every 10 minutes. So you can calculate by that maybe in a few years, basically the speed at which money supply increases is basically 0%, right? So that's cool, right? You can use that information to maybe price Bitcoin in a monetary sense, which we'll talk about soon. And lastly, it's immutable. Immutable in the sense that once a transaction has been secured through proof of work, as you saw, in order to change any part of the chain with new information, you have to redo all the computational work from that point on that you want to make the change. And so it's basically impossible to make corrections. So as you can see, this is very bad for people who make mistakes, right? When transferring funds to their friends or whatever. So if you want to make a transaction on the blockchain or Bitcoin, you better do it with large sums of money. And it'd be something that you want to be permanent, right? Okay. So value beyond those benefits is controversial. I mean, it's just like any sort of commodity like oil. You're speculating on future people buying it from you, whether it's gold. Well, gold has the same problem. Oil has the same problem. People are just speculating what people are going to pay for in the future. And so Bitcoin is it's not different than that. If you want to have an analogy with Bitcoin with companies, think about social networks in which people move from one network to the other. So I don't know about China. I don't know if Weibo or whatever has always been the top social network, but in the US, people have moved from Facebook has not always been the predominant one. There has been MySpace, for example. There has been Friendster. Once people move from one network to the original network becomes worthless, right? And Bitcoin is no different, right? If people stop conducting transactions on Bitcoin, then there's no activity. Then it's just miners, exchanging with one another. The value of as we learned from this class, right? Money comes from the fact that people demand the money to get access to something, some service. Good, ideally something tangible, right? Like international trade. But as far as I understand, Bitcoin doesn't grant you access to anything that money doesn't already give you access to, other than moving your money away from certain countries that have capital restrictions. There is a case, you can make a case recently. So I know that certain pornographic websites no longer take Visa and MasterCard, and the only way to access these pornographic sites is through Bitcoin. So in that sense, Bitcoin does have some, tangible backing, right? It's backed by your access to pornographic services. Okay, but then you get my point here, right? So people can easily switch from one blockchain to the other. In fact, there are many spin-offs on Bitcoin. If you've been following Bitcoin, there's Bitcoin Cash, Bitcoin Core, Bitcoin Gold, all these variations on Bitcoin. They're just spin-offs, but for some reason or the other, they all have value because people transact on it. People stop transacting on it, that's when it loses its value. There's been lots of blockchains that basically go into zero because people don't transact it on anymore. And there's no more miners, essentially. So much like social networks, if you don't have people on it, their miners don't have any incentives to mine things, and therefore I see no reason why the blockchain has any sort of value whatsoever. Okay, so maybe just to give you an idea that we can use the models we have at hand to price Bitcoin, we can use relative PVP. So maybe I'll go over this model and then go over the rest of the stuff next week. So we can evaluate the long-term return of holding Bitcoin using relative PVP. We know where relative PVP comes from. It comes from the real exchange rate equation. So using the rule of changes, we have the following expression, and we know how we can calculate this, right? We know BTC inflation, we know USD inflation, and we can compare what's the predicted value of the returns on Bitcoin relative to, for example, US dollar versus what you see in the markets, right? So you have a fundamentals-based valuation based on relative PVP versus what you observe. So let me give you some numbers here. So the numbers here is the following. So we have liquidity demand for Bitcoin be derived as 20%, and that's because we defined inflation of Bitcoin to 0%, and we defined US dollar inflation as 0.16%. So of course, this is before the pandemic, right? So I apologize, the numbers don't make sense. But it shouldn't be as astronomical as 20%. So based on the returns that you observe, based on the inflation rate of the US dollar, based on the inflation rate of Bitcoin, based on money demand for BTC, do you expect the BTC demand to be 20% per month, right? It's just absurd, right? This is a monthly, I believe, yeah, monthly return. So just to tell you how crazy Bitcoin is relative to the other asset classes, S&P 500 has a distribution of monthly returns in the following. It has centrality or between 0 and 5%. Obviously, it's crazy to go anything beyond 10%. For gold, 0 to 5% centrality, but again, crazy to go beyond 10%. Now look at Bitcoin. This is between, I think, 2009 to 2020, I believe. You have 150% possibility, right? There's a possibility that Bitcoin increases in value by 150% in a given month. All right, that's nuts, right? This is something you would never expect to see it for any stock in the US, right? So with that in mind, this is why you get such crazy numbers that there's 20% increase in adoption over the month, average adoption over the months between 2009 to 2020, right? It doesn't make quite a lot of sense. Okay, so I'll stop here and then I'll complete my discussion on Bitcoin later, valuation. If you have comments about this week's lecture, you can talk to me after class. Otherwise, next week is fully dedicated to going to reviewing. So no more new topics. Your question might be, how am I going to test you on Bitcoin? I will test you on Bitcoin only based on the facts you saw in the video and in the slides. So I won't ask you mathematical questions. I will basically just ask you, what is proof of work? And then it's like multiple choice, right? How do you define, like, how do you decide which is the correct chain? The chain with the most work, right, is the correct chain to follow. Stuff like that. I won't ask you like any technical question about private key, secret key. Just very, very basic knowledge of blockchain is all I'm testing you on. Okay. Anyways, I will go over. Next week is all questions and related to the final and nothing else. Right? No new topics. All right. See you guys next week.